Trillions of dollars are moving right now, not on Wall Street, not in Silicon Valley, but in a quiet, fluorescent-lit building at the Federal Reserve Bank of New York. Every night, massive waves of cash flow in and out of something most Americans have never heard of, the reverse repo facility. It's not a conspiracy. It's not a secret vault of gold. It's a hidden piece of the financial system so strange that even a lot of Wall Street can't clearly explain it. And yet, it quietly controls more than $2 trillion in cash. Before we dive in, make sure to subscribe and like this video if you love exploring the secret side of global finance and history, the parts of the system that shape your money without you even realizing it. Alright, let's lift the curtain on one of the strangest money mysteries in modern economics. To understand the reverse repo crisis, we first need to decode the repo system itself, short for repurchase agreements. Imagine a repo like a pawn shop for financial institutions. A bank, or more commonly a money market fund, lends cash to another institution, often the Federal Reserve or a major bank, in exchange for collateral, usually US Treasuries. The next day, that collateral is repurchased at a slightly higher price. That tiny difference is the interest or yield. It's a short-term loan that keeps the plumbing of global finance flowing. But what happens when everyone wants to lend money and nobody wants to borrow it? That's when the reverse repo comes into play. In this case, it's the Fed borrowing cash overnight from private institutions, offering treasuries as collateral. Now that might sound harmless. After all, it's just a daily shuffle of money between financial players, right? But here's where it gets strange. As of 2022-2023, the reverse repo facility has ballooned to over $2 trillion, money effectively parked at the Fed earning interest. This isn't normal. This is the financial equivalent of everyone trying to squeeze into the same lifeboat at once. So how did we get here? The roots of this crisis trace back to the pandemic era, when the Federal Reserve unleashed a historic wave of quantitative easing, printing money to buy bonds, mortgage-backed securities, and treasuries. This flooded the financial system with liquidity, too much liquidity. Money market funds and institutions suddenly found themselves sitting on oceans of cash with nowhere safe to park it. Yields on short-term treasuries and commercial paper dropped near zero or even negative in real terms. That's when the Fed opened the reverse repo facility wider than ever before, essentially offering to take in excess cash from the financial system overnight, paying a small amount of interest known as the RRP rate in return. It was supposed to be a safety valve, but that safety valve turned into a black hole. By mid-2023, nearly every major money market fund in America was using it. Pension funds, mutual funds, and even foreign central banks started piling in. Everyone wanted to park cash safely at the Fed. What began as a temporary measure became a permanent parking lot for trillions. And that's when the cracks began to show. Because while the Fed was absorbing all this cash, it was also raising interest rates at the fastest pace in 40 years to fight inflation. Suddenly, the Fed found itself paying interest on all that parked money, billions per month. It was an ironic twist. The same central bank that once created money out of thin air was now losing money by the truckload. But that's only half the story. The other half is more dangerous and more misunderstood. When that much money sits idle in the Fed's reverse repo facility, it doesn't circulate through the economy. It's frozen liquidity, money that can't be lent, spent, or invested. It's as if someone pulled $2 trillion out of the bloodstream of global finance and locked it in a vault. Banks, already hesitant to lend due to tighter regulations, became even more cautious. The repo markets, once the lifeline of short-term funding, started to thin out. And then a strange thing happened. While inflation was supposedly being tamed, parts of the financial system started showing signs of deflationary stress. Liquidity disappeared from places that needed it most. Bond markets became unstable. The Treasury faced difficulties finding consistent buyers. The financial pipes that used to hum with activity were now echoing with emptiness. Analysts began calling it the reverse repo trap, a situation where too much money parked at the Fed actually destabilizes the broader economy. It's like a car engine flooded with fuel. Instead of powering forward, it stalls. But why would institutions rather park trillions with the Fed instead of lending it or investing in the economy? The answer lies in trust. After multiple bank failures, liquidity scares, and market shocks, big players simply don't trust the system the way they used to. Parking money at the Fed is risk-free. Lending it into the market isn't. And that's the paradox of modern finance. The very mechanisms designed to stabilize the system are now making it fragile. In the old days, when cash piled up in money markets, it would eventually flow back into lending, fueling business expansion, infrastructure, or investment. Today, that flow is jammed. The Fed is effectively competing with the private sector for capital and winning. Every dollar parked in the reverse repo facility is a dollar not circulating in the economy. That's why some economists warn that this isn't just a technical problem, it's a hidden monetary tightening that few are talking about. But there's an even deeper layer to this story, one that reaches into the psychology of financial institutions themselves. Because at its core, the reverse repo crisis isn't just about money, it's about fear. Fear of counterparty risk, fear of regulation, fear of volatility. In a world where everything feels uncertain, from inflation to war to political instability, the Fed's reverse repo window has become the ultimate safe space. Yet safety always comes at a cost. The $2 trillion sitting still doesn't just vanish. It represents frozen opportunity, untapped growth, and ironically, the same kind of systemic imbalance that caused crises in the past. And if history tells us anything, when money stops moving, economies start breaking. At first glance, the reverse repo facility looks like a model of prudence. It gives financial institutions a risk-free place to stash their cash, keeps short-term interest rates stable, and helps the Federal Reserve maintain control over monetary policy. But underneath that calm surface lies a dangerous irony. The very thing meant to stabilize the system has become a hidden source of instability. To see how, let us start with a simple question. What happens when everyone wants safety at the same time? In a normal economy, cash is the grease that keeps everything running. It moves through businesses, households, and governments, stimulating growth. But when trillions are locked away in the Fed's reverse repo facility, the grease turns to glue. Liquidity, the lifeblood of finance, gets trapped in the vault of the central bank. Money that should be circulating through lending, mortgages, or investment ends up sitting idle, earning a few basis points of interest. This is the quiet paradox of modern monetary policy. While the Fed claims to be tightening the economy by raising rates, it's actually creating a new imbalance, a liquidity vacuum. Let's visualize it this way. Imagine an economy as a river. The Fed, in its effort to control inflation, builds a dam, the reverse repo facility. At first, the dam keeps the water level steady, preventing flooding, but as more and more water, cash flows in, the reservoir grows larger while the river downstream begins to dry up. The crops, businesses, credit markets, and small investors start to wither. The dam becomes too successful at holding water back. Now, multiply that by $2 trillion, sorry. Here's where the real danger begins. Every night, when trillions flow into the reverse repo facility, the Fed effectively borrows from the private sector. That means the Fed owes interest on that money, around 5.3% as of recent rates. So on $2 trillion, that's over $100 billion per year paid out by the Fed to large financial institutions like BlackRock, Vanguard, and JP Morgan's money funds. Who ultimately bears that cost? You do. The Federal Reserve doesn't print profits out of nowhere. When it pays interest on reverse repos, it's reducing its own earnings. And since the Fed's profits normally go to the U.S. Treasury, that means less revenue for the government. In 2023, the Fed reported negative income for the first time in decades, largely because of these interest payments. In other words, taxpayer money is indirectly subsidizing Wall Street's thirst for safety. But that's just the accounting side. The bigger issue is psychological because the more institutions use the reverse repo facility, the more dependent they become on it. They begin to view it not as an emergency tool, but as a permanent fixture, a free guaranteed return with zero risk. It's the monetary equivalent of addiction. Why lend to a small business or buy corporate bonds when you can park your cash at the Fed and earn interest risk-free? That's how we end up with what economists call financial repression in disguise. When capital is incentivized to hide in safe assets instead of fueling innovation, productivity slows, wages stagnate, and the economy becomes risk-averse. And ironically, that risk aversion breeds instability because the system becomes so reliant on central bank safety nets that it can't function without them. The reverse repo facility, in that sense, has become a kind of shadow central bank managing liquidity, not through traditional policy tools, but through quiet manipulation of incentives. Now here's where things get even darker. Remember that the Fed created this facility after the 2008 financial crisis to give money market funds a safe place to invest. But when the Fed pays interest to these funds, it's effectively competing with the US Treasury itself, because both the Treasury and the Fed are borrowing from the same pool of investors. Think about that for a moment. One arm of the US government is now competing with another arm for cash. The Fed offers short-term overnight rates. The Treasury offers long-term bonds. When the reverse repo facility becomes too attractive, investors pull money out of Treasury bills and park it at the Fed instead. The result? The Treasury struggles to find buyers for its debt. And that's not a hypothetical, it's happening right now. In recent months, auctions for US Treasuries have shown weak demand. Primary dealers are being forced to buy unsold bonds. The US government's cost of borrowing is rising, and all the while the Fed is holding trillions of dollars that could be funding those very bonds. It's a circular absurdity. The central bank that was supposed to support government borrowing is now unintentionally crowding it out. The more the Fed tries to control the system, the more the system contorts in unexpected ways.
And yet, despite all this, most people, even investors, barely know this facility exists. It doesn't make headlines like inflation or GDP growth. It's buried deep in the Fed's balance sheet, quietly shaping global liquidity flows behind the scenes.
But for the people who do understand it, the reverse repo facility is a warning sign. It is a signal that the system has too much short-term cash and not enough productive places to put it. It's the financial world's version of hoarding, a symptom of deep dysfunction. Let's not forget markets thrive on balance. When everyone wants to lend, there must be borrowers. When everyone seeks safety, there must be risk takers. When that balance collapses, crises follow. And in that sense, the reverse repo facility is more than a financial tool. It's a barometer of fear. The higher its usage climbs, the more nervous the system becomes. So what happens when that fear flips? What happens when institutions stop using the reverse repo and start pulling their money out all at once? That's when we enter uncharted territory. A liquidity flood that could destabilize short-term markets overnight. The same mechanism that drained liquidity could suddenly unleash it in a surge, like opening the dam gates all at once. If that happens, interest rates could swing violently. Treasury yields could spike or collapse, and banks could once again find themselves struggling to manage collateral and reserves, just like during previous repo crises in 2019 and 2008. In other words, the reverse repo facility isn't just storing money, it's storing tension, trillions of dollars of it, waiting for the next big shift. History shows that when financial pressure builds up in hidden corners of the system, it never stays hidden for long. To understand the true danger of the reverse repo facility, we have to talk about what happens when the tide turns, when the money parked at the Fed starts to flow back out into the real economy. Because every system built on artificial stability eventually reaches a breaking point, and the reverse repo is no different. For nearly 2 years, money market funds have shoveled trillions into the Fed's overnight vault, seeking safety from inflation and volatility. But that money isn't locked forever. It can leave as quickly as it arrived. And when it does, it could set off one of the most violent shifts in liquidity markets since 2008. Let's rewind to the original purpose of the reverse repo facility. It was never meant to be permanent. It was supposed to be a temporary tool to help control short-term interest rates. When banks had too much cash and Treasury yields were near zero, the Fed offered an outlet to keep rates from falling below target. Simple enough. But now the facility has become a key pillar of the financial system. It's not just a safety valve anymore, it's part of the plumbing. Money market funds rely on it. Corporations use it indirectly. Even global banks price short-term borrowing off of it. So when the day comes that those trillions start to move, say, when Treasury yields rise high enough to look more attractive, it won't just be a liquidity shift, it'll be a seismic reallocation of capital. Picture this, $1 trillion leaving the reverse repo facility and flooding into Treasury bills almost overnight. It sounds harmless. After all, it's still within the financial system. But in practice, that shift means the Fed's liabilities shrink while Treasury borrowing suddenly spikes. Yields could swing dramatically, short-term funding markets could seize up, and once again, the Fed would find itself scrambling to restore order. If that scenario feels far-fetched, it's not. We've seen smaller versions of it before, most notably in September 2019, when the repo market experienced a sudden liquidity shortage. Overnight borrowing rates exploded from 2% to 10% in a single day. The cause? A combination of too much cash being locked in reserves and too little available to fund Treasury settlements. Sound familiar? The 2019 repo crisis forced the Fed to inject hundreds of billions of dollars into the market almost instantly. It was a preview of how fragile the system has become and how quickly stable mechanisms can backfire. Fast forward to today, the stakes are far higher. The size of the reverse repo facility is 10 times larger than the entire repo market was back then, which means any sudden unwinding could dwarf the 2019 shock in scale. And here's the kicker. The Fed is already losing control over it. In early 2024, as the Treasury issued a flood of new short-term debt, usage of the reverse repo facility began to fall from over $2 trillion to under $700 billion. On the surface, that looked like good news. But in reality, it revealed just how sensitive the system is. Each shift in Treasury yields triggered massive outflows, and each outflow sent shockwaves through short-term markets. Think about that dynamic. If money leaves too fast, short-term rates could fall sharply, undermining the Fed's entire tightening effort. If it leaves too slowly, the Treasury struggles to sell its bonds. Either way, there's no smooth exit. The Fed is caught in what some economists now call the reverse repo trap. Every decision it makes, whether to raise rates, cut rates, or taper its balance sheet, changes the incentives for trillions of dollars sitting in the facility. Move too fast, and liquidity floods the system. Move too slow and money stagnates, starving credit creation. This is the ultimate irony. In trying to fine-tune control over the economy, the Fed has built a machine that reacts faster than it can. Now add one more complication: global contagion. Foreign central banks, sovereign wealth funds, and multinational corporations all interact indirectly with the U.S. repo system. When liquidity conditions in the U.S. tighten or loosen suddenly, the ripple effects hit everywhere from London to Singapore to Tokyo. A sudden shift in the reverse repo facility could cause collateral shortages in one market and excesses in another, triggering currency volatility and capital flight. This isn't just theoretical. In late 2023, a sudden drop in reverse repo usage coincided with pressure on the yen and Chinese yuan currencies tied closely to dollar liquidity. Investors began moving capital defensively, anticipating shocks in funding markets. What makes all of this so dangerous is how little the public knows. Central banks don't hold press conferences about repo operations. There are no viral charts explaining why $1.7 trillion disappeared from a facility most people have never heard of. Yet these quiet moves dictate the flow of global capital. And here's where the real-world impact shows up. When liquidity drains or floods suddenly, markets react, mortgage rates swing, corporate borrowing costs change overnight. Pension funds lose stability. It doesn't matter if you've never heard of the reverse repo facility. It's influencing your rent, your 401k, and even your job security. For ordinary people, it manifests as volatility, uncertainty, and confusion. One week, credit feels easy. The next, it feels impossible. That's because the entire financial system is now built on short-term confidence, and confidence is fragile. Let's zoom out for a second. The reason the reverse repo facility exists at all is because the post-2008 world never truly healed. Central banks replaced organic market trust with artificial stability, low rates, liquidity injections, and endless interventions. The reverse repo facility is just the latest manifestation of that same philosophy. Control the flow of money and you can control the economy, but control has limits. The more dependent the system becomes on central bank micromanagement, the less resilient it becomes. And as we've seen time and again, from the 2008 crisis to the 2019 repo spike to the 2020 pandemic panic, fragility always finds a way to reveal itself. When that day comes, the reverse repo facility won't save the system. It'll amplify the chaos, because it's not a safety net. It's a mirror reflecting how distorted our monetary world has become.